What if I told you that one of the most valuable assets owned by the United States government is officially priced at just $42.22 an ounce, even though the market says it's worth nearly 100 times more? It sounds impossible. It sounds like a typo hidden in a spreadsheet. But it isn't. That single number has survived presidents, financial crises, inflation, recessions, and the collapse of the gold standard. Almost nobody talks about it. Yet it sits quietly on the government's books, raising one uncomfortable question. Is it simply an outdated accounting rule, or is it a forgotten window into how modern money really works? Because once you understand why America's gold is still valued at $42.22, you'll start looking at the Federal Reserve, the US dollar, and even your own savings in a completely different way. And by the end of this video, you'll see why some investors believe this overlooked number could become one of the most important financial stories of the decade. One of the biggest mistakes investors make is assuming markets move because of headlines. They don't. Headlines explain what already happened. That's why long-term investors constantly evaluate policy direction rather than individual headlines. The future rarely changes because of one announcement. It changes because incentives gradually shift. This brings us back to the mysterious $42.22. Perhaps it remains nothing more than an accounting relic. Perhaps it eventually becomes part of a much larger monetary conversation. No one knows. But here's what history consistently teaches. A forgotten accounting rule, an obscure Treasury report, a little discussed Federal Reserve document, a quiet policy proposal. Then suddenly, years later, everyone realizes those small details were early warning signals. The question isn't whether history repeats itself exactly. It almost never does. The real question is whether today's policymakers face pressures similar to those faced by previous generations. Debt, confidence, currency stability, global competition, reserve diversification. Those pressures look surprisingly familiar. And in the next section, we'll examine where this story could go from here. We'll explore 3 realistic future scenarios. The risks investors should actually worry about. The opportunities that many people may be overlooking, and why one decision made in Washington over the next few years could reshape how global investors think about gold for the next decade. If you ask the average investor what backs the US dollar today, you'll hear answers like the economy, the military, government bonds, or simply nothing. But hidden deep inside government accounting records is a number that seems frozen in another century. $42.22. That is the official book value assigned to America's gold reserves. Not the market price. Not the price investors see every day. Not the price central banks are paying. Just $42.22 an ounce. And the deeper you look into how that number survived decade after decade, the more fascinating the story becomes. Because this isn't simply about accounting. It's about the evolution of money itself. To understand why, we have to travel back nearly a century. The United States once operated under a very different monetary system. Gold wasn't merely another investment. It was money. The dollar itself represented a fixed claim on gold, and confidence in the currency depended on the government's ability to maintain that relationship. That system placed strict limits on policymakers. Governments couldn't simply create unlimited amounts of money whenever spending increased. Every major monetary decision carried consequences because gold acted as an anchor. Then came the Great Depression. Banks failed. Businesses collapsed. Unemployment soared. Confidence disappeared almost overnight. Faced with an economic emergency unlike anything Americans had experienced before, policymakers began searching for new tools. One of those tools fundamentally changed the relationship between the dollar and gold. Over time, the role of gold inside the monetary system gradually shifted. Instead of functioning as the foundation of everyday money, it increasingly became a reserve asset held by governments. Eventually, the United States moved away from direct gold convertibility altogether. Yet one strange detail remained. The official accounting value of America's gold never evolved with the market. It simply stayed behind. Frozen. Decades passed. Inflation reshaped the economy. Currencies floated freely. Technology transformed finance. Entire generations entered the investment world. Yet somewhere inside federal accounting books, America's largest gold reserve continued to sit at approximately $42.22 per ounce. Why? Because accounting serves a different purpose than market pricing. Government balance sheets are designed for consistency, budgeting, and legal reporting rather than reflecting daily fluctuations in asset values. In other words, the number isn't necessarily trying to estimate what America's gold is worth today. It's simply the historical value used for official bookkeeping. But markets don't care about bookkeeping. Markets care about reality. And reality says something very different. Today's gold market values those same reserves dramatically higher. That enormous gap creates one of the most unusual contrasts in global finance. On paper, the asset appears modest. In economic reality, it represents one of the world's largest strategic monetary holdings. Now here's where things become even more interesting. Because while most retail investors never think about government gold, central banks clearly do. Over the past several years, central banks across multiple regions have steadily increased their gold reserves. This isn't speculation. It's observable. Many monetary authorities continue diversifying reserve portfolios by adding physical gold alongside traditional currency holdings. Why? Not because they expect a return next quarter. Not because they're chasing momentum. But because gold performs a role few other assets can replicate. It carries no issuer risk, no corporate earnings, no political campaign, no bankruptcy process. It simply exists outside the liabilities of another. History has repeatedly shown that during periods of uncertainty, governments often value optionality. Gold provides exactly that. And this is where investor psychology begins to diverge. Retail investors often focus on headlines. Professional money managers focus on probabilities. Institutional investors ask different questions. What happens if inflation remains higher than expected? What happens if interest rates eventually fall? What happens if debt servicing becomes increasingly expensive? What happens if confidence shifts across global reserve markets? Notice something important. None of those questions require predicting catastrophe. They simply acknowledge uncertainty. Markets don't price certainty. They price possibilities. That's exactly why portfolio diversification exists. Now let's connect this back to the Federal Reserve. The Fed doesn't manage policy based solely on gold prices. Its mandate revolves around inflation, employment, and financial stability. But monetary policy influences every major asset class. When interest rates rise aggressively, holding cash becomes more attractive. When expectations shift toward lower rates, opportunity costs change. Capital begins searching elsewhere. Sometimes into equities, sometimes into bonds, sometimes into commodities. And historically, precious metals often become part of that conversation. That's because gold behaves differently from many traditional financial assets. It isn't driven by quarterly earnings. It doesn't pay dividends. Its performance often reflects changing expectations surrounding monetary conditions, inflation, currency confidence, and global uncertainty. Silver, meanwhile, introduces another layer. Unlike gold, silver carries substantial industrial demand. Solar technology, electronics, artificial intelligence infrastructure, medical applications, electric vehicles, advanced manufacturing. Its investment story isn't purely monetary. It's also industrial. That combination creates unique cycles. Sometimes silver follows gold. Sometimes it lags. Sometimes it dramatically outperforms. Professional investors understand these relationships. They don't assume history repeats perfectly, but they recognize patterns. And history provides valuable context. Consider previous periods of monetary transition. Whenever financial systems experience significant change, whether through inflation, currency adjustments, or policy shifts, hard assets frequently attracted renewed attention. Not because they guaranteed profits, but because uncertainty increased their relevance. That's an important distinction. Markets rarely move because of one headline. Instead, they respond to cumulative changes. One employment report, one inflation release, one central bank meeting, one Treasury announcement, one geopolitical event. Individually, each may appear manageable. Together, they gradually reshape expectations. That's exactly how institutional money thinks. Not in days, not even months, but across broader cycles. Meanwhile, individual investors often become trapped by emotion. When prices rise rapidly, fear of missing out dominates. When prices fall sharply, panic replaces patience. Professional investors try to avoid both extremes. Instead of asking, what's happening today? They ask, what environment is developing? That subtle difference changes everything. Because wealth isn't usually built reacting to yesterday's headlines. It's built by understanding larger trends before they're obvious. Which brings us back to America's mysterious $42.22 figure. The number itself isn't what moves markets. The conversation surrounding it is. Every time discussions emerge about government assets, monetary credibility, reserve policy, inflation, or fiscal sustainability, investors begin asking deeper questions about the financial system. Those conversations matter because confidence remains one of the world's most valuable economic assets. Currencies function because people trust them. Markets operate because participants believe contracts will be honored. Financial systems depend upon confidence far more than many realize. History repeatedly demonstrates that maintaining confidence often matters just as much as maintaining liquidity. And that's why experienced investors spend less time chasing predictions and more time studying incentives. They understand governments adapt. Central banks evolve. Policies change. Markets adjust. Cycles repeat. But human behavior remains remarkably consistent. Fear, greed, optimism, panic, patience. Those forces never disappear. They simply wear different disguises. Today, America's forgotten $42.22 accounting figure reminds us that financial history never truly disappears. Sometimes the smallest details hidden inside government documents reveal the biggest questions about where monetary policy could be heading next. And if that's true, then the next chapter becomes even more important. Because right now, several economic forces are beginning to converge simultaneously. Debt, interest rates, central bank strategy, global reserve diversification, currency competition, and investor confidence. Individually, each deserves attention. Together, they may define the next major financial cycle. Every major shift in financial history begins the same way. Not with a market crash. Not with a headline. Not even with a Federal Reserve announcement. It begins with something that almost nobody notices. A small accounting detail. A policy discussion buried inside Washington. A balance sheet entry that suddenly becomes important because the world around it has changed. That is exactly where America finds itself today. The question is no longer whether gold matters. The real question is what happens if the United States is eventually forced to acknowledge that its official valuation no longer reflects financial reality. No one knows if that day comes next year, 5 years from now, or 20 years from now. But history suggests governments rarely revisit old accounting systems unless pressure is building somewhere beneath the surface. And today, that pressure is increasing from several different directions at once. Government debt continues climbing. Central banks continue accumulating physical gold. Geopolitical competition is accelerating. Currency systems are becoming increasingly fragmented. Taken individually, none of these developments guarantee change. Together, they deserve attention. That brings us to 3 realistic scenarios investors should consider. Ironically, this is probably the most likely short-term outcome. The Treasury keeps valuing America's gold at $42.22 per ounce. The accounting remains untouched. Congress avoids the issue. Markets move on to the next headline. Life continues. And for years, most Americans never hear about the number again. This has happened before. Governments often leave outdated accounting systems in place because changing them creates political questions nobody wants to answer. If nothing changes, investors probably continue focusing on interest rates, inflation, earnings, employment, and Federal Reserve meetings. Gold still trades according to global supply and demand. The accounting value simply remains a historical artifact. For long-term investors, this changes almost nothing. But history also reminds us, systems can remain stable, right up until the moment they suddenly aren't. This possibility receives surprisingly little public attention. Imagine policymakers deciding the Treasury should simply update its gold valuation to something closer to today's market price. Not because America is returning to a gold standard. Not because dollars suddenly become redeemable for bullion. Simply because the books no longer reflect economic reality. From an accounting perspective, that would instantly increase the reported value of America's official gold holdings. Some analysts argue this would strengthen the government's balance sheet. Others argue it changes nothing because the gold was already there. Markets would likely spend days debating the implications. Financial television would explode with conflicting opinions. Some would call it cosmetic. Others would call it historic. The truth probably lies somewhere between those extremes. Because accounting changes rarely matter by themselves. What matters is what investors believe they signal. Markets trade expectations, not spreadsheets. If investors interpreted such a move as preparation for broader monetary reforms, gold prices could react. If they viewed it as meaningless bookkeeping, markets might barely notice. Perception has always been one of finance's most powerful forces. This is the least likely, but also the most fascinating. Around the world, countries are exploring alternatives to the existing financial architecture. Some are increasing gold reserves. Others are experimenting with digital payment systems. Some are conducting trade outside the traditional dollar framework. None of this means the dollar is disappearing. Far from it. The US dollar remains the world's dominant reserve currency. Its financial markets remain the deepest and most liquid on Earth. But history shows reserve currency systems evolve over decades. Not overnight. The British pound once dominated global finance. Before that, other currencies held similar positions. Every monetary system eventually changes. Not because someone announces the end, but because incentives gradually shift. If the global monetary landscape continues evolving, gold could play a larger psychological role than many investors currently expect. Not necessarily as everyday money, but as neutral collateral, a reserve asset, or a confidence anchor inside an increasingly uncertain financial system. That possibility explains why so many central banks continue buying physical bullion. They're preparing for futures, not predicting them. Whenever gold begins making headlines, two emotional extremes usually appear. The first group becomes convinced civilization is ending. They believe every headline confirms disaster. The second group dismisses everything. They assume nothing important is happening because life feels normal. History suggests both reactions are dangerous. Successful long-term investors rarely operate from fear. They also avoid complacency. Instead, they ask better questions. What information is changing? What incentives are changing? Who benefits? Who is preparing before everyone else notices? Those questions often reveal far more than daily market predictions. Because investing isn't about predicting every move. It's about recognizing major trends before they become obvious. Large institutions rarely make billion-dollar decisions based on YouTube videos, social media posts, or breaking television headlines. They spend enormous resources studying history, policy, debt, currencies, capital flows, geopolitics, risk. They understand something individual investors often forget. Financial systems don't usually fail because of one event. They evolve through hundreds of small decisions that slowly reshape incentives. By the time the average investor notices, institutions have often been adjusting portfolios for years. That's why understanding monetary history matters. Not because history repeats perfectly, but because human behavior rarely changes. The most important lesson isn't that America values its gold at an outdated number. The real lesson is this: financial systems contain assumptions that almost nobody questions, until suddenly everyone does. For decades, $42.22 has quietly remained on government books without attracting widespread public attention. Now, as debt rises, currencies compete, gold reaches record highs, and central banks continue accumulating reserves. People are beginning to ask why. That doesn't mean change is guaranteed. It simply means curiosity is returning. And curiosity often comes before policy discussions. History rarely announces its turning points. Most of the time, people recognize them only after they're already living through them. Perhaps $42.22 remains an obscure accounting figure for another generation. Perhaps future policymakers eventually decide it deserves another look. No one knows. But asking the question may prove more valuable than pretending the question doesn't exist. Because markets reward informed thinking, not certainty. And whether you own gold, stocks, cash, or nothing at all, understanding how money evolves may be one of the most valuable investments you ever make. So now I'd like to hear from you. Do you believe America's official gold valuation is simply an outdated accounting relic? Or do you think it points to a much larger monetary conversation that hasn't reached the mainstream yet? Share your thoughts in the comments. If you enjoyed this deep dive into monetary history, Federal Reserve policy, and the hidden mechanics shaping today's financial system, subscribe for more macroeconomic analysis designed to help you see the bigger picture before it becomes tomorrow's headline. Because sometimes, the biggest financial story in America isn't the one making the news. It's the one hiding in plain sight.